Okay, well, we've seen rates being put on hold recently, but how do you think that will affect the market and when will they go up?
Look, the market's pricing in at the moment one rate rise probably sometime after mid-year, with the possibility of a second rate rise towards the end of the year. If that does play out that way, I don't think it'll impact the market too significantly. If we were to have more than 2 rate rises, I think we would see a further slowdown in credit growth, that's for sure.
And what do you make of the war between the big 4 banks at the moment?
Look, I don't think, the banks certainly I don't think are going to win materially themselves. At the moment consumers are winning, so home buyers and investors coming into the market are being spoilt for choice at the moment. There's a lot of incredibly good offers out there. I think we'll see it play out for another couple of months, but the offers that are being made are incredibly sharp and are not going to do the right thing for the bank's margins. So I can't see it as a long-term play.
What about small banks?
Look, the small banks are the ones that are going to struggle during this war, because they can't match the sort of pricing discounts that the major banks have on offer at the moment. So they'll still rely on being competitive, but more so focusing on the things that they do well, which is providing exceptional customer service and certainly post-settlement service. And again, understanding these bank wars, they really are a result of the government's competitive and sustainable banking reform package that was released in December, that signalled 2 things. It signalled, 1, that they wanted to remove exit fees, and 2, that they wanted to create a more competitive second-tiered banking environment with this 5th pillar. What we're seeing now is the first part of this played out, with a couple of banks jumping on this removal of exit fee, and that's triggered this enormous level of competition. The sad part is that whilst in the short term consumers will win, in the medium to long term, if exit fees are abolished, it's going to be very damaging to the competitive offerings of small banks, and ultimately that's not a good thing for consumers. We all know that banking oligopolies are not a good thing from a pricing and an innovation perspective. So there's a fair bit to play out here.
Okay, and so what are your predictions of how the market will pan out this year?
Look, I think the outlook for property, well, certainly for credit growth first, credit growth is going to be very subdued still. So, with respect to the last 3 or 4 years, we are used to a double-digit credit growth environment. We're now down at a single digit, and I would think for the next couple of years it's going to be sub 8%. So that'll be subdued, and in terms of property prices, I think they'll stay fairly flat. We're seeing at the moment, even though we've still got an undersupply of property, so demand is certainly still exceeding supply, and that's keeping property prices quite stable. With this softening of credit growth, it's probably turning to be more of a buyer's market at the moment. The only thing that'll dampen that is that with home buyers coming back into the market for the bottom level, the bottom tier of property, they will be competing head on with property investors. So that competition for lower price property will probably keep the price of property quite stable.
And so do you think that the incentives for first home buyers brought in 2 years ago have actually done more harm than good?
Yeah, look, it's a good point. There's no doubt that mid-2009 we had the first homeowners contributing around 28.5% of all home buyers. December 2010, so a year and a bit later, that number's come right back to 15.5%. So there's no doubt that in 2009, particularly running up to the end of the expiration of the first homeowners boost, a lot of first home buyers brought forward their purchase decisions. Now, some of them invariably may have been a little bit premature, attracted by the additional boost. And that leads you into this whole discussion around mortgage stress, and it's really not, mortgage stress isn't so much of an issue because the banks certainly price into their assessment rate a number of rate rises when they assess a borrower for their capacity to borrow. What is most concerning, and what showed up in our first homeowner survey that we've just completed of 800 first homeowners, is that 19% of the 803 first homeowners that have bought a home in the last 2 years, 19% have taken on significant additional debt. And this is probably the concern. It's not so much mortgage stress, but it's the additional debt people take on when they buy their first home. So certainly the message to first homeowners is, you know, they really need to be very diligent, and they really need to keep to their budget in their first 3 or 4 years of buying a home, and not go out and upgrade their cars and furnish the place and take on additional debt.
So any other advice for investors out there?
Look, I think in terms of potential investors, the economic backdrop is really favourable for investors at the moment. You know, we've got a stable outlook in terms of prices. We've got a fairly stable interest rate outlook as well. We've got a very low vacancy rate. And we've got a high population growth. So the environment is good for property investors. But as we always say, the property investors need to look at property as a long-term investment, not speculate and be turning property over every 2 or 3 years. They're not going to be able to do that because the outlook for property prices is quite stable. So property investors need to look at property as a long-term investment, and they need to make sure that if they're going to build a property portfolio, that they structure their finance correctly. So they need to make sure that they do go to a very competent and professional mortgage broker to really structure their finance appropriately, and they need to understand in that respect the pros and cons of structuring standalone finance as against structuring via maybe a cross-collateralisation strategy. So that's the message.